right. Yeah, welcome, Thomas. Today we have Thomas Faber from Rudy Capital, and let's just jump straight into the matter. And why don't you give us a personal background and what got you into crypto?
Yeah, thanks for having me today. Maybe just briefly about myself. So, I have a background in management, finance, and philosophy. Studied at Frankfurt School of Finance, and I've always been very enthusiastic about technology, especially digital technology from a young age on. And so, it's not very surprising that I got into crypto very early. Um, Although not that deeply in 2015, 2016. So, I had my first touch with Bitcoin, like many people. And then, yeah, through my network at the Frankfurt School and a good friend of mine and my co-founder Philipp Schulden, I finally made my way to Professor Sandner at the Frankfurt School Blockchain Center. Worked there for a couple of years and did all kind of stuff from standardization initiatives to academic paper writing, consulting, education, presentations, lectures, and so on. So a very broad spectrum that gave me quite a very good, I would say, perspective on things going on in the market and helped me a lot to understand what I really like to do. And yeah, through the exchange with Philipp Sandner and many other people from that network, a lot of ideas came out. And one of that idea has been Rudy Capital that we have been implementing for almost a year now.
All right, thanks a lot. And what exactly does Rudy Capital do?
Yeah, so we are a German-based advisory boutique for decentralized finance strategies. We are engaged in that market research. We develop risk and return models for that new world. And we also construct portfolios and simulate portfolios according to the risk appetite of the investors and risk preferences. So those are basically our three pillars. And we also consult different kind of investment vehicles on what strategies to follow when, like how do you construct a market neutral or delta neutral portfolio in decentralized finance, including lending, liquidity provision, staking, and so on. But also, yeah, consulting in terms of what are my risks, and so how do I identify them, measure them, assess them, and mitigate them, basically.
And what is your main role in the entire spectrum? Or are you all over the place?
So we're still early stage, so I'm more or less all over the place. But I'm mostly responsible for all activities in regards to market research, risk management, and portfolio construction. So my co-founder Philip is more active in marketing and sales, business development, and kind of more on the more technical side of things.
Nice. Cool. Now, we're going to be talking about the value propositions and what you actually do with Rudy Capital in just a moment. But there are a few concepts that we will be touching upon quite a few times, and it would be cool if you could quickly introduce the audience to it. So could you briefly explain what a stablecoin actually is, what liquidity mining is, staking, and impermanent loss?
Okay, yeah, I'll try my best. Stablecoin is probably the easiest one. So a stablecoin is basically a cryptocurrency, a token on a blockchain that is pegged or aims to be pegged to a reference value in the real world. And that reference value could be almost anything you can imagine, right? The most popular one would be the US dollar. So most stablecoins are pegged to the US dollar. You have stable coins that are pegged to the euro as well. Tether basically emitted one out of the United States, ironically, lately. We have stable coins that are pegged to gold or other metals. And yeah, within stable coins, there are different kind of types. I don't know if we go in more deeply into that. But it's very interesting because they can be backed by fiat currencies. So for every token you have on the blockchain, there is a real reserve somewhere in a safe, basically. And then there are crypto-backed stablecoins such as Maker's DAI, where you have all kind of different cryptocurrencies in the reserve. So when you go to Maker and you put your reserve into the protocol, you can get out some stablecoins. But you have to over collateralize it because of the volatility of the reserve. And then we have algorithmic stablecoins. We had an interesting time with Terra Luna. So UST was basically a good example of an algorithmic stablecoin that failed. Typically, algorithmic stablecoins are based on an algorithm, based on incentives and game theory. So they're not backed by anything.
Okay.
Yeah, so that's stablecoins.
Stablecoins, yeah. Liquidity mining?
Yeah, so liquidity mining is basically what people refer to when they think about decentralized exchanges, right? We have that new type of exchanges on the blockchain that do not work with an order book anymore, but rather as a so-called automated market maker involving a liquidity pool. So liquidity pool instead of an order book. So you're not peer-to-peer trading with someone else sitting somewhere else in the world. You're trading with a liquidity pool, and prices determined basically, or token amounts by a certain kind of formula. So that enables everyone to be a market maker or a liquidity provider, right? So you can select a certain trading pair, you go on a decentralized exchange such as Uniswap or SushiSwap, and then you pick a trading pair. And typically, there are some edge cases, but typically you invest in a 50-50 ratio, right? If you have a USDC Ether trading pair, you invest 50% USDC, 50% ETH. And what you get is a share of the trading fees. For Uniswap, you get actually 100% of the trading fees right now as a liquidity provider. And yeah, so let's just say there's one trader and that trader wants to swap USDC for Ether. He, for example, pays 0.3% for that trade, right? And those 0.3% go to the liquidity providers in that liquidity pool. That's the basic concept, let's say, of a liquidity pool. And yeah, impermanent loss is basically, yeah, it's a concept associated with liquidity pools that often makes it unattractive for investors to invest if you don't calculate the risks correctly, or if you're not really aware of how that really works. What basically happens is, if the price of one asset diverges relative to the price of the other asset, you have impermanent loss because you are buying the inferior asset on your way down, right? So if you have a Ether USDC pool and Ether is dropping in price, you are buying Ether on your way down, kind of like a range order. And you end up with a different token amount than you used to before. And permanent loss refers to what your tokens are worth then compared to what they would be worth if you simply held them in a wallet. And yeah, that's very interesting because that's one of the key performance metrics that you need to monitor in order to know if your liquidity pool is indeed profitable or not. So you have liquidity pool gains, which is your trading fees, and then you have impermanent loss. So if you want to know if you're making money on that pool, you need those two metrics basically. Come to market gains in a second. You need those two metrics. You have your liquidity pool gains, trading fees, and you subtract the impermanent loss, and then you have your net gains, excluding market changes, right? Mm-hmm. That's on another level. You then have the price of your assets involved in the pool, but that simply follows at the typical price structure. So that's independent of the changes of the token balances.
Yeah. Okay. Yeah, I mean, there's tons of material on this, right? And I think impermanent loss is best explained visually. But yeah, thanks a lot for this actually really good introduction on that. So last point would be staking. Could you also quickly lead into that?
Yeah, there are different kinds of staking. So that term is actually really hard for beginners to think about, because there is stake token staking, right? Or governance token staking, or liquidity pool token staking. So you can stake all kind of tokens. So maybe we'll start with that. You often have, let's just say you provide liquidity to a decentralized exchange, then you are able to, let's just say stake that liquidity. You'll lock it for some additional returns, because it's just good to have liquidity locked, right? And then on the other hand, you have governance token staking, which are typically governance tokens from protocols that you get rewarded for staking. And then when you stake them, you get let's just say you get to have a say in some certain discussions or decisions and so on. And then we have network staking, which would be primarily proof of stake staking, right? So what people, that's probably what people think of the most if they hear about staking. It's, how can I stake my Ether? I can typically do that with a staking provider such as Lido or staking pools. I can do it myself, run my own validator for 32 ETH. Probably not possible for the small people or people with small investment amounts. I think it's very important to kind of understand what's going on in this space to differentiate between the certain types of staking. So I think that was quite misleading for me in the beginning, actually.
Mm-hmm. Yeah. True. So let's speak about to Rudy Capital a bit more. So your tagline is stabilizing the world of decentralized finance. So knowing from experience, that is not straightforward to achieve, and it actually sounds like the dream for institutional investors who basically want to have limited exposure to market risk, but still benefit from it. Right? I think this is what it rolls up to. Could you explain, like in simple terms, how you're actually generating these steady and positive returns?
Yeah, so it's actually a combination of the things that we've just discussed. So liquidity pools, then we have lending as one pillar. It's not that lucrative anymore, but I would say it's mostly liquidity mining or liquidity provision at the moment, which has proven to be in the best risk reward ratio possible at the moment in the market, as long as you have the right hedges in place. But that's kind of the challenge. You can hedge your lending positions very easily, right? Because it's just simple directional exposure, and I don't know, you lend really any token for a stable coin. You don't need a hedge at all, at least not against market risk or price risk. And then you have, I don't know, you lend ether, and then you just hedge against the price risk of ether with a, I don't know, shorting a perpetual future or with options. And yeah, it gets a little bit more complicated with liquidity pools because yeah, as I've just explained, you have that impermanent loss that is basically an additional concept associated with liquidity pools. And it's quite complex to hedge and very expensive because it has a curvature, right? So you can't simply go and just, I don't know, increase your simple short, because yeah, you have actually a gamma that you need to hedge as well. And that is, I would say, the most challenging part, to actually say, well, is it worth it to hedge impermanent loss or not? In most cases, it's not, right? The better approach is to look at pools that do not incur as much impermanent loss. So in the pre-selection process, so that would be trading pairs that are, for example, highly correlated to each other, because again, impermanent loss is basically, or is then incurred if one asset changes very, very strongly relative to the price of the other asset in the trading pair. So typically we don't hedge against impermanent loss. We do so in very, yeah, in some cases, but mostly not. But rather in the pre-selection process, look at how attractive is a certain liquidity pool, and are the assets correlated or not. We look at what's the market sentiment, right? Because obviously any liquidity pool is basically a long position, and it works very well in environments where prices are rising. It gets more difficult to hedge if, yeah, in a market environment like we see it right now.
Yeah, yeah, indeed. We could talk about that for quite some time, I think. But let's keep it high level for the moment. So, can you also talk about who your main investors are, or who the people are that are entering these strategies? So it's obviously not private individuals, right? If I understand correctly, or at least retail investors. But could you explain who you're addressing specifically, and maybe also why?
Yeah, so interestingly, there are private investors that are really interested in it because yeah, they have some affinity to the space. They are enthusiastic about the space and very bullish on the vision of what's happening in general. But they typically don't have the time to invest in, you know, doing their own due diligence on all that strategies. And yeah, the market environment currently, I mean, what's the best investment right now? It's really hard to tell, right? People don't want to see volatility right now. They don't want to have too much downside risk. So market neutral strategies are very popular at the moment. So that's one target group that's very interested in our products, because they don't have the time to invest. They have a lot of money they want to protect. There's some, yeah, I would say they're mostly bullish about the crypto market over the next couple of years, and so they trust in the market somewhat, right? They trust the market to go up in the long run. We don't target people that did not have really a touch with the market, or that are not really interested. So we're not going into a sales call and people are very skeptic about crypto, and then we try to educate them 5 hours long, and then they say, well, okay, interesting, but no. So yeah, it's more about people that have some kind of experience within the space, and yeah, are somewhat euphoric in the long run, and then We have, of course, the more professional side, family offices that try to diversify their portfolios further, looking into alternative investments, especially digital assets. It's very complex for them to, one, have the infrastructure in place, because it requires to be compliant with a lot of very difficult regulations. Then it's very hard for them to make investment decisions. Obviously, I mean, it can be simpler to just have a basket of assets. Let's say, well, Bitcoin and Ether is nice, so we just hold Bitcoin and Ether for 10 years. That's very simple, but it gets a lot more complicated if you want to do market neutral stuff, for example. So we help them to get that done, or help them to and point them to investment vehicles that do that out of the box, basically. And we also have private banks that are interested into this, or there are a few Swiss banks that are very progressive when it comes to digital assets, because they have customers that really demand new solutions for investments. So we talk to them. So it's really quite a broad spectrum, from high net worth individuals to family offices, private banks.
Yeah. Okay. So, but in general, these people, I think you mentioned, are mostly informed about what's going on, right? And so what's lacking seems to be access and compliance to certain regulations. Interesting. So, do you also have AUM for your own company, or do you only issue those vehicles in the form of bond?
Yeah. So Rudy Capital Germany is an advisory boutique that consults different kind of investment vehicles, and one of those vehicles is based in Liechtenstein, for example, and it works very simple. That vehicle emits a bond that has a very variable interest rate. So capital is coming through the bond into the company, and then those assets are managed within that company. And at the end of the year, you get some profit, and that profit is going to basically partly to us as the advisor, so a management and performance fee comparable to that. And then you have some vehicle costs, right? And then the net profit is basically going to the investors as a coupon. That's how you can think of it. And that specific vehicle I'm talking about has a target return of 15% for investors.
Okay, cool.
And it's market neutral, so volatility is.
I was going to say,
yeah. So I mean, 15% doesn't sound like a lot, but it's certainly a lot if you don't have any fluctuation, or almost no fluctuation in the portfolio.
Yeah, and I think whenever you're talking to professional investors, then yield is just one component of it, right? And I mean, for those of you who are inclined, there's this famous Sharpe ratio, and this also takes risk into account. So if you can reduce your deviations of these returns by that much, then obviously your Sharpe ratio goes up by quite a bit.
Yeah, it's interesting what you're saying. Sharpe ratio is very important, because every return you make or might make, you have to relate to the risk, or it's worth nothing, right? It doesn't say anything. 4,000% in a liquidity pool. So what? Why is it 4,000%? So you have to look into it, and I think the art behind it is to find the asymmetric investments. Where can I get the most return with comparably less risk? So that's basically what we're doing. We look into the returns, but very, very specifically on the risk side. So we focus much more on risk management than we do on finding the best returns. Because once you know the risks, you can find the returns or those asymmetries better, right? So that way has proven to be much more effective in finding the best risk return strategies than the other way around. And you mentioned the Sharpe ratio. So the Sharpe ratio is an interesting metric, but it works very, very poorly in the space of decentralized finance, because let's just say we have a market neutral portfolio, or we have a stablecoin strategy. It has an infinite Sharpe ratio, basically, right? Because you have almost no volatility. So then the question is, okay, so there must be some risk that is not included in the Sharpe ratio. And then you have all kind of risks on the blockchain level, on the protocol level, on the asset level, on the strategy level itself, right? Market risk, we talked about impermanent loss, liquidation risk, slippage. So there's all kind of stuff that you need to worry about when making such decisions.
Mm-hmm. Yeah. Yeah, that's true. So I know that Oscar has got a few questions about product categories, but could you quickly summarize what categories you're offering right now?
So as an advisory, we are very deeply involved in market research, of course, because that builds the foundation for everything we do. That means we have people that go into the rabbit hole very deeply in Discord channels, crypto, Twitter, so all the places that are relevant. So because today you don't read the New York Times or anything if you want to know something about crypto, right? So you have to go very, very deeply, and you have to build trust with relevant players in the market to get good information and to get it before many other people get it. And so you have to build relationships to people in the space, and that's a lot of work. And we want to create value for the space because the space is extremely important for us. I would say we support most of the agenda that is associated with Web3, like sovereignty of people. And we see our way more going into the more decentralized space, starting out as a more centralized institution, but basically going more into the decentralized space with time. So market research very important. And then we have the risk management part. That's building models. So we touch a little bit upon the certain kind of risks, right? Blockchain, protocol, asset strategy, and so on. Somehow you have to make sense of that, right? So you can identify and measure a lot of things, like incredibly. You can measure thousands of metrics and look at sentiment and all kind of stuff. But in the end, it's important to identify the relevant parts and then to make sense out of it, right? So have to look at all the different kind of risk levels, and then you multiply basically those scores. So we give every risk level, we look at the blockchain, say, well, okay, what's the software quality, what, I don't know, how do the nodes look, centralization, how long has that blockchain been on the market or live, and what's the community. And so you look at all that kind of stuff, and then you give it a score, basically, in simple terms, and you do that for every risk level. And in the end, you multiply all those scores, because once one of these levels defaults, everything defaults because it's built on top of each other, right? If the blockchain defaults for some reason, you have a huge problem with your position. It doesn't matter if it's in protocol A or protocol B on that blockchain. And so that's basically I would say the most difficult part of what we do: identify, measure, assess, mitigate risks, building the models for it. And then a bit associated with that is measuring the returns or categorizing returns as well, because you have more or less sustainable returns. Sometimes unsustainable returns are driven by rewards. So you have to look, if it's interesting, you have to look at where do those rewards come from? How long will they be there for? Or are we entering today and tomorrow the returns are gone, right? So you have to look at all these kind of things. We talked about liquidity pools. You have to somewhat look at liquidity pools and just say, well, that's attractive. If you have a lot of volume on very little TVL, could be a good sign, right? If it's a stable pool, you eliminate certain kind of risks like impermanent loss, or you mitigate them at least. If you have an Ether USDC pool, you have a huge risk for impermanent loss, but you have a whole lot of volume and good trading fees. So it's basically about just identifying those risks, measuring them, assessing them, developing hedging strategies, and on the other side, making sure that the returns are stable, sustainable, or if they're not, to making sure that you can at least run them for a certain period of time.
All right. So you touched upon sustainable returns, and I think in the last year we've all seen Olympus DAO and its forks, and I think it's very important to really understand what kind of risk you're dealing with. And it seems like you guys are doing it on a very professional level, and I would assume that 99% of the market doesn't do it on such a professional level, and doesn't really understand where those returns are coming from and also the risk associated with it. But we can touch upon the risk later on again. And first of all, I would like to understand, what does your infrastructure look like as soon as you decide to invest into a protocol or into a liquidity pool? Do you invest into the liquidity pools through a decentralized exchange, or do you mainly work with centralized exchanges because it seems to be safer than actually doing everything through a decentralized exchange, because there is
less opportunities for being hacked and everything. Could you touch up on that?
Yeah, sure. So we use MPC custody powered by Credo. And on top of that, we use MetaMask institutional. And that has worked very well for us because Credo includes some nice governance features. So you have certain kind of approval processes that you can customize, because obviously you don't want to have one person to have the full control over your wallets and over the transactions. One, because it's always good to not trust everyone, even though we have a great team. But two, it's also it makes you less vulnerable to attacks from the outside if you have, for example, two mobile phones that need to be hacked at the same time. So that's our basic infrastructure. We have, of course, centralized on-ramps because that's the only way to go. And that was that has been a huge mess, by the way. So that has cost us a lot of nerves and a lot of time to be basically KYC'd by those exchanges, and we hear that from a lot of other funds as well. So you have to send them hundreds of documents, and they still come up with some more questions. But yeah, anyway, so that's the only way to go. And you can basically think of wiring money from a traditional bank account to a centralized exchange. You on ramp it there, so by, for example, swapping it for stable coins or for any other token, and from there you can go to your wallet. You can withdraw it from that centralized exchange to your wallet, and then you can engage just freely with any DeFi protocol. Let's say, as long as it's on an EVM chain. So that's the limitation of MetaMask Institutional and Credo right now. But it's sufficient for us. So we would be able to go on other chains as well, but would need a different custody solution. But then we wouldn't have the governance and the security that we want. Mm-hmm. So we're sticking on EVM right now. Yeah.
And Credo, that's written with a Q, if I'm not mistaken.
Right, yeah? Right.
How has that experience been for you? Because I've looked at it as a private investor beforehand and was a bit stunned by their very inflationary tokenomics, but apparently they have onboarded a lot of institutional customers, so to say.
Yeah, I mean, what's nice about it is that it's decentralized and that it's not as expensive as their competitors. And from what we know and what we've seen, for example, Fireblocks is not as progressive. And Fireblocks does not really have us as target customers, it seems, because they're more interested in big institutions that, just do not that very difficult, complex stuff, but rather hold certain kind of tokens or maybe lend a little bit through the battle tested protocols such as Aave. But they're not really for degen activity, right? not saying we're degens, but we need that we need that flexibility to hook into every DeFi protocol. And yeah, you're somewhat limited with Fireblocks and others that we talk to, and Credo just seemed to be the best one overall. So there are certainly advantages that other services have over Credo, but yeah, overall it's a good choice. Has been a good choice.
Sorry to interrupt, but are you mainly doing things then on chain, or are you ever also going into something like, for instance, I don't know, options trading on Deribit or something like this, which is basically UI driven or API driven?
Yeah, so most of the hedging is done on centralized services. So, for example, FTX, OKX are used for trading perpetual futures. Then Deribit is the only place to go in the crypto market when you want some good liquidity on options. We've looked into on-chain derivatives exchanges, but they still come with certain kind of disadvantages that we just can't bear at the moment. So we're still using centralized services for that. But certainly are thinking about bringing that on chain as soon as that's possible without too much friction and hassle and risk. And yeah, after all, I mean, there's a lot of good services coming up in DeFi in that space right now. You have, for example, GMX, right? Trace Ethereum. So there are synthetics and DYDX. So there's a lot of development going on. And so, yeah, as soon as that gets better, even better, yeah, we want to switch on chain and build our vaults for that, right? Because a lot of our investments involve at least partly manual work. And we really would like to automate that in the near future.
Yeah, that sounds like a pretty complex structure. And are you doing all of that with 4 people in your team, or is there more than on your website?
We are 6 people.
6 people.
Currently. Yeah, we have basically it's Philip for marketing, sales, business development, and strategy together with me. Finance we do also together. Then we have Julio, who is mainly responsible for working with our IT infrastructure and data. So connecting to the APIs, building our own database. So we have a huge amount of data in our database. That's, for example, yield data. So we measure, I can look it up. I think we have 9 or 10 million data points just on yield farms and a lot of history. I think we are tracking almost 3,500 strategies in real time on, I think, 60 protocols across, 25 chains. So just a lot of data, and Julio is doing an insanely good job in collecting that data, making sense out of it. Then we have Christian, who is heading our research, and he's very good into going into the very, very detail of things. So when most people stop, Christian goes deeper and deeper and deeper until he really hits the bottom. And then we have support from Nikolai in all our social media activities and in general outreach. And then, of course, a couple of freelancers, a small freelancer army that supports us in, primarily IT, I would say, IT and outreach. And that's it's a very cool and interesting team and complementary team, I would say. And the open labor market makes it a lot easier for startups to just be progressive and go forward fastly.
Yeah, super interesting. And you said you go, or Christian goes into detail where others stop, and you also said beforehand that you actually dive into the Discord and Telegram channels. Can you give us an example of what kind of information you're looking for, and also like how you evaluate if a project has a good community, and like what factors you look at?
Yeah, so I think it would make sense to have a conversation with Christian if you want to go really deep into that. But what's interesting is if you look at the health of a certain community, right? You just look at the vibes, at activity. You can look at, for example, governance proposals. What kind of activity is there? Is activity driven by a few individuals? Is activity driven by many individuals? What kind of activity is it? Is it a very toxic environment where people fight a lot? Is there a lot of misunderstanding or a divergence in the ideology or vision of the protocol? So that's obviously all very qualitative. So subject to, I don't know, how do I perceive it, right? But there is currently not really a better way to go about it. So that's why we have a schema, or let's say a qualitative framework that you can go over it, and it's basically like an exam, right? You have some questions and you check it, and the protocol gets certain kind of points if they check the box. If they're not checking the box, they don't get any points. So that's very important about the community. But it's also, the question is, what kind of governance is it? Is it a real on-chain governance, or is it like an off-chain governance? Because obviously off-chain governance is subject to people not following what actually has been decided, right? But on the other hand, you don't have a lot of real on-chain governance in the space. Then there you have protocols such as Liquidity that have no governance at all, which is also interesting. So is that now good or is it bad? It's certainly both. And so far about the governance. But if you enter a Discord, you can do that for many reasons. You just want to exchange with people about certain topics to just dive a little bit deeper, because you read a white paper and most of the time you don't get all the information you need from a white paper, or it's almost never you get everything you need. So you go into a Discord space and you just write your questions in the channel. You do some due diligence questions. Economics is obviously important. Just kind of see who is rewarded, what's the vesting schedule. I don't know. So certain different kind of metrics that are relevant for tokenomics as well, even though it's not a direct risk to an investment position. It's rather indirect. Still need to consider it, but it's not as important as other things. And obviously you look at the team. So are those people anonymous or are they doxed? Right? Most people are anonymous in the space, which is not really an advantage. So if a team is doxed, or at least partly doxed, well known in the space with a certain kind of track record, that's good. If it's anonymous and not well known, it's not good because it increases the risk of rug pulls and or I don't know, smart contract bugs because you assume it's not an experienced team behind it. Yeah, I think that would be most of the qualitative side.
Mm-hmm.
Yeah,
and that also means that you're looking at quite a few projects, I suppose, and those are also like the length that you have to go to produce those returns that you're promising, right? Because it's probably not enough to just take blue chip projects and provide liquidity there, because the returns don't seem to be as high as for higher risk plays, right?
yeah, it's partly true. I mean, things really changed with Uniswap V3 because you have so many parameters that you can control or not control. So that can be very, very lucrative if you know what you're doing. So, and Uniswap is a blue chip protocol. And concentrated liquidity in general is a phenomenon or a concept that we're seeing within, for example, Trader Joe now as well. So it's coming more and more, but it gets really complicated. So we're seeing all those liquidity optimizers, right? V3 liquidity optimizers, although none of them is really good. I think they're not really doing a good job because they have misaligned incentives. You have people coming in early that have, now a large amount of impermanent loss, and the protocol is not rebalancing because you would realize that impermanent loss. So there's all kind of, yeah, it's very early. Let's put it this way. It's really early, and as I said in the beginning, it's all about risk reward. So it could be that there is an exotic product or service on, I don't know, Aurora. Umami Finance was an example. They had a liquidity mining event, and we looked very deeply into it, and you could loop your tokens, you could borrow and get rewarded for borrowing, right? And you could loop the strategy a couple of times to leverage it and get like 50, 60, 70% on a stable coin for almost a month. That was really cool, but in the end we didn't do it because there was no insurance market for the protocol risk. And if we related the risk that we calculated, it didn't make sense. So in the aftermath, it would have been a good idea because Umami still lives and wasn't hacked, right? But afterwards, you always more than you know in the moment. So there was still good reasons to make that decision in that moment. But yeah, we look at all kind of different chains, and special events can be very lucrative. It's really hard to say if a project is really, really new, right? If it's a couple of weeks or a couple of months, so it's really hard. So you look at stuff like who's backing that project. Is there any popular VC invested in them? So you kind of, yeah, let's just say you think their due diligence was good, right? So they did due diligence with information that you don't have. So you trust that they have information you don't have, and obviously made a decision that it's a good team, but it's not sufficient. Those are just indicators.
Right, that makes a lot of sense, and I think especially in the DeFi space, we're seeing a lot of innovation also when looking at cross-chain DEXs like ThorChain, for example, where you can swap native tokens, and where there's a lot of transfer of liquidity from different chains, right? And that also increases the risk of hacks and everything. And have you looked into something like that already?
It's not on the table for us right now. No.
Okay. And coming back to your different products that you're offering, could you explain to us how those delta neutral strategies for the bond that the vehicle in Liechtenstein is issuing works?
Yeah, sure. So typically on a monthly basis, we write a consulting paper to that investment vehicle. And then that consulting paper involves a market overview. So where's the market right now? Are there any special risks to consider? Just a quick wrap up on where we are in the market. And then there are basically some, I would say, recommendations on what kind of strategies make the most sense in such a market environment. Right? So that could be, for example, liquidity provision. If the market is looking good, then it's more attractive to go into liquidity provision than if the market is bad. It still works if the market is bad, but it's just more attractive. So we kind of rank the different kind of yield types, right? From DeFi options vaults to lending, liquidity provision, staking, what makes the most sense. And then we go one level deeper and kind of recommend certain kind of big strategies. Like, let's just say, well, provide liquidity to trading pair X on Uniswap or stake token X at protocol Y. And yeah, then in the end, you have a holistic strategy paper every month that tells you from broad to specific what to do or what we recommend to do, but the investment decision itself is still made by the investment vehicle and the board of directors.
Okay, that explains a lot. And how much does an individual, you said like there's wealthy individuals, for example, or family offices, how much do they have to invest to be able to take part in that vehicle?
For the Liechtenstein vehicle, it's a minimum of 100,000 euro, US dollars, or Swiss francs. And that's just based on regulation. So it's not a number that we came up with. It's just the least a minimum investment amount for professional investors.
Okay. And yeah, I think you've already answered that question, but why does it have to be crypto, and why couldn't it be like a traditional market?
There is a lot of arbitrage opportunities in a new and I would say almost experimental market. So you have a lot of knowledge arbitrage because we know things other people don't, including the processes and models that we build and need to know to make those decisions. And yeah, I think that's the biggest one actually. And then you have, of course, regulatory arbitrage in the market. It's not a well-regulated market. It's almost not regulated, right? So the DeFi space itself. So there is some arbitrage there if you can make it happen in the regulated world to build a vehicle that is able to invest in it, right? So there's some arbitrage there. And the third point is that in the traditional market, you have to be a very, very large player to make certain kind of things. So you can't just start with $1 million in your pockets and say, well, I'm going to be a market maker now. So it's not going to work. And in DeFi, things are different, right? Anyone can be a market maker. My mom could be a market maker today if she wanted to, with just $10. And I think it just opened a lot of opportunities to people and smaller institutions that were not present in a traditional financial market before.
Okay. Yeah. Thanks for explaining that.
Cool. So maybe we can go into the risk side of things a little bit. So aside from the risks associated with the depegging of stablecoins, smart contracts, what other risks do you have to hedge against?
So it differs a little bit from strategy to strategy. We talked a lot about liquidity provision, so maybe we just stay with that for a moment. On a strategy level, if you're in a liquidity pool, you have the risk of impermanent loss. So that's a big one, and we've discussed it already. Then there is a risk called slippage, price slippage, which is just the difference between the price that you're quoted and the one you're getting in the end, right? And then we've all heard about the MEV bots that front run you in transactions and that extract value from your transaction. So you have to kind of make sure that you set your slippage tolerances right. That's actually a big one that many people don't know, especially the beginners. There is almost always a default slippage setting at around 1% in many protocols. And depending on what you're swapping, that's quite a lot, right? If you're swapping stablecoins and you have a 1% slippage, depending on the stablecoin pair, that can be quite dangerous. So slippage is a big one, and permanent loss is a big one. And then, obviously the protocol itself, Uniswap. I mean, in that example, it's a battle-tested protocol with one of the most capable teams in the space, audited multiple times. So not too much risk on the smart contract side or on the technological side of things, but still you have tail risks, and you want to account for them because once they materialize, the consequence is pretty bad. So it's typically your funds are gone. So low probability, but still high consequences. Then we have the involved assets itself. Right? What kind of assets am I investing? DPEG, you already mentioned. DPEG is a big one for stablecoins. So you want to make sure that you have good stablecoins in your portfolio, or if you're more experimental, you have to make at least sure that you're hedging against the DPEG. You can do that by borrowing the stablecoin if there is a good market on it, or shorting the perpetual, or insuring against it. Yeah, that's also possible depending on the asset. Then what else do we have? We have the blockchain, right? That the Ethereum blockchain is obviously the most secure blockchain on the market. It's at least a smart contract capable blockchain that has been proven for many years. It's very decentralized, although we have the merge coming up, so there's some risk. But yeah, that's a very secure blockchain. We have other alternative layer 1 blockchains such as Phantom, for example. Great tech, I think. Nice community, but obviously there's more risk and centralization risks, for example, involved in that blockchain, and also in many other alternative layer 1 blockchains. So it's a trade-off, right? It's much cheaper to operate on a blockchain like that. It's typically faster, but it's also it comes with more risk, and returns are higher typically also because of that. Risk return correlation is very present on these chains, so that's why many people are on them, ignoring the additional risk, right? I think we covered most of it. So I mean, yeah, there are other strategies. Lending, for example. If you lend in a pool, you want to make sure you get your funds out. So the liquidity in general is very important, right? Some liquidity pools can get very imbalanced, and if you have a huge amount of funds invested in a specific pool, you want to see that the pool is balanced, so you can get your liquidity out if you need to in an emergency situation, or just if you just need it. So that's what we're looking into. Yeah, lending over as collateralization ratio basically is important. How good are the liquidation engines of certain protocols is very important, because if let's just say I lend my money, I want to make sure I get it back. And so what helps in that is that you have over collateralization, so that you have people that have collateral, or that, let's just say, they position more collateral or invest more collateral than they take out a loan for. But if that collateral is volatile, and let's just say I take my Bitcoin to Aave and or my Ether, and I want to borrow against it, I just can borrow 70 or 80% against it, or I should, right? Because obviously when the collateral is changing in price, then I might have a problem, because the collateral has less worth than what I borrowed. So yeah, the protocol takes care of that, because it triggers a liquidation in case you reach the liquidation price. But that must work properly, right? Because if it doesn't, the protocol is building up debt, which is also called bad debt. So yeah, liquidation engines are important. Then obviously oracles. What kind of oracle is involved? Where do the prices come from? Is it a Chainlink oracle? Is it I don't know, a centralized self-built oracle? Yeah, that still exists. And yeah, utilization ratio is a thing in lending pools. So if you look at the supply and demand side, is there just as much demand as supply? The more demand per supply, obviously the higher the utilization ratio. And yeah, those are all kind of things that are important to consider. It sounds more complicated than it is in the end, actually. You just have to know what you're looking at. And yeah, that's lending. I think those are the most important ones, really. Maybe just one word to auto compounders, because a lot of people are using them, like Yearn Finance, or I don't know, Harvest Finance. There are a lot of them out there. It's a nice concept, but it also involves an additional layer of risk, because you're using their smart contracts, and what you're getting is a little bit of comfort, because you don't need to compound yourself. But it's really important to calculate what the benefits of an auto compounder are versus doing it manually. Because if you are engaging in a strategy that has 20% APR, then obviously compounding doesn't really bring you a lot of joy, right? Because then you have 21 or 22% APY, so compounded gains. It's more relevant to higher APRs, but then those are not sustainable in most of the cases. Yeah, so auto compounders, nice concept. We don't do it. Not saying they don't provide value to the ecosystem, but yeah, just saying be cautious and calculate really what it brings in value to your position.
Yeah, it's certainly a productization of convenience, right? In this sense. Yeah. as you said. Last question we wanted to touch upon was, how do you see the market performing over the next 12 months? The crystal ball.
Yeah, that's a difficult one. Not sure I can add a lot of value on that compared to people that are more involved in macro work. But I'm doing some technical analysis on charts as well, and it's obviously not looking very good, right? So what is possible, in my opinion, is that we see a short squeeze because we are at a very, very strong support zone right now, especially on Bitcoin. If it holds, and I assume it will, we might see a very nice short squeeze because a lot of people are very, very bearish right now, and there is a huge overhang of shorts compared to longs at the moment. So if we see a good capital inflow, we might trigger a lot of shorts to cover their positions and go up in the short term. So I actually hope that happens. But if we don't and we lose that major support, things look very ugly. So then I see us coming down significantly. Like, it's really hard to tell. Don't want to make real predictions about it, but I think we can go much lower than most people think. It's not over.
Yeah. Well, reflects our take, right? I mean, as much as we would like to think the opposite, but it's just the situation now.
I mean, the faster we get over it, right, the faster we might have a good and healthy market again. So most people are just hoping, knowing that it might very well drop lower. So please go lower today, so we can recover faster. Just get it over with, because it's very painful to see the market bleeding so slowly, right?
Yeah.
You look at your phone every morning and it's like, oh damn, 2% lost again, right? And it's that slow bleeding is very, very bad. So I would prefer a huge drop and then a quick recovery.
And you also didn't see, I mean, right now you don't really see clear indications, right, for either of the two sides, whereas in other market situations, I mean, you can look at a trend and, hey, yeah, it's kind of moving in this direction, right? Whereas at the moment, it's like there is so much uncertainty in the market, and you're looking for like nimble signals, like these short squeezes you were mentioning. But it's not like this is a strong bullish signal, like in the long run, right? But it's simply not.
Yeah. No, I mean, the question is, where's the capital coming from? Like the capital is not coming from you and me, I assume. The capital is coming from big institutional players, and they have a different kind of risk management. They typically have traditional risk management instruments, a traditional view with some crypto salt in it, right? But it's the same mechanics that determine if there is capital flowing into risk on assets or not. So we saw a bear market rally that was probably mainly retail driven, but it didn't hold long. Yeah, so it was exit liquidity at its finest again. So it's not a sustainable capital inflow. And unfortunately, I assume that we won't have that for some long time, depending on, I mean, how things play out. There are a lot of risk factors: energy crisis, I don't know, China, right? Lockdown, China's economy. Then we have still a war going on. It's just so hard to tell what's going to happen.
Yeah, indeed. All right, Thomas, thank you so much for being with us today. I think it was extremely insightful, and we're gonna have a lot of fun digesting this. Again, thanks for coming, and all the best going forward. I think you're on a really cool journey despite the market conditions, or actually especially during these current market conditions, right? Because like it's basically proving what you guys are doing. So yeah, best of luck for that.
Thanks for having me, guys. It was fun. Thank you.
Yeah. Thanks also from my side. It was a super interesting conversation, and I think we could have dragged this on for another 2 hours, but that's maybe for another time.
We sure do. Yeah. Thank you.